Silver is rebuilding, and the market has no idea what's coming. Silver is rebuilding, and the market has no idea what's coming. In January of this year, silver touched $121. Then, in a matter of days, it collapsed. The headlines called it a crash. The analysts called it over. The traders walked away. But something quiet, something patient, started happening underneath. Real buyers, real demand, real pressure building. 6 consecutive years of the world consuming more silver than it could pull from the ground. Solar panels, electric vehicles, artificial intelligence, all of them hungry. And yet, the market still hasn't looked up. The question is not whether this moves. The question is, are you positioned before it does? Welcome to AU and AG, the house of gold and silver, where serious money meets serious analysis. Now, before we go any further, think of this channel like your most trusted old friend, the one you called before making any big decision, the one who never rushed, never panicked, and was always right, just a little ahead of everyone else. If you haven't subscribed yet, do what that friend always told you to do when something important was in front of you. Don't wait. Act now. You'll thank yourself later. Hit that subscribe button because the people who found this channel early will understand why it mattered. And while you're here, drop a comment below and tell us, where in the world are you watching from tonight? Whether you're in Karachi or Cairo, London or Lahore, New York or Nairobi, we want to know who is in the room. Because what we are about to break down affects every economy, every currency, every business decision, wherever you are. Now, let's begin. Something unusual is happening in the silver market right now. Not loud, not dramatic, not the kind of movement that makes breaking news headlines or floods financial platforms with bold predictions. It is quiet, almost too quiet. And in markets, silence like this has a history of preceding something significant. On January 29th, 2026, silver touched $121.67 per ounce. It was a number that stunned even the most experienced analysts, a number that represented years of suppressed pressure finally breaking through the surface. Traders who had waited patiently were suddenly looking at generational returns. Forums were active. Institutions were scrambling. The world briefly was paying attention. Then it crashed. In a matter of days, silver lost nearly half its value. It fell toward the $60 range with a speed that left most retail investors paralyzed. Those who had just entered the market at higher levels watched in disbelief. Those who had called for $150 went quiet. The bears returned with confidence. The headlines shifted. The general conclusion reached quickly and shared widely was simple. The silver rally was over. But here is what those headlines missed. When serious analysts studied where silver actually found its floor, they noticed something that did not fit the narrative of a broken market. The price did not collapse to $40. It did not revisit $50. It found support at a level far higher than the most aggressive sell-off models had predicted. And then quietly, without celebration, without volume, spikes, without any of the signals that typically accompany a recovery in a speculative market, it started climbing back. As of February 25th, 2026, silver is trading at approximately $87 to $88 per ounce. That is not the behavior of a dead market. That is not the chart of an asset that the world has decided to abandon. That is a market rebuilding its foundation one steady session at a time. Real buyers absorbing real selling pressure. Patient capital replacing panicked capital. The kind of price action that experienced observers recognize not as noise, but as structure. The market, however, is still not paying attention. Most analysts have moved on. Most retail investors are still recovering from the shock of the January correction. And the institutions that are quietly accumulating at these levels prefer it that way. The silence before a signal is never accidental. And in silver's case, right now, that silence is speaking very loudly to those who know how to listen. Every market crash has a surface story and a real story. The surface story is the one that spreads fast, the one that fills news segments, gets quoted in financial columns, and becomes the version most people carry with them long after the dust is settled. The real story takes longer to find. It requires patience, context, and the willingness to look past the headline and into the mechanics of what actually happened underneath. In January 2026, the surface story was simple. Silver went too high too fast, speculators got carried away, and the market corrected violently. That version is not entirely wrong, but it is dangerously incomplete. Here is what the surface story left out. United States Treasury Secretary Scott Bessent stepped in front of the cameras and delivered a statement that sent a precise signal through global financial markets. He attributed the extreme price swings in both silver and gold to speculative activity, and he named Chinese traders as the primary force behind that speculation. That statement was not casual. Statements from a Treasury Secretary are never casual. Every word is measured, Every target is chosen deliberately, and the market heard the message clearly. Regulators in China moved almost immediately. Margin requirements on precious metals futures were raised. Position limits were tightened. The message from Chinese financial authorities to their own market participants was direct and unmistakable. The paper market had overextended itself, and a correction was not just coming, it was being engineered. What followed was one of the sharpest and most concentrated sell-offs the silver futures market had seen in modern history. But here is the detail that changes everything. When governments and regulators intervene to force a correction in a commodity market, the price typically overshoots to the downside. Fear takes over. Leveraged positions unwind simultaneously. And the asset in question usually falls far below any reasonable estimate of its fundamental value before buyers return. That did not happen with silver. The floor held higher than anyone expected. The buyers who stepped in were not retail traders chasing a bounce. They were patient, systematic, and well capitalized. They absorbed the selling without drama and without announcement. And the price began rebuilding from a level that suggested something far more durable than speculation had been supporting silver all along. There is a particular kind of crisis that never makes the front page. Not because it is unimportant, but because it moves too slowly for the news cycle to care about it. It builds across years, sometimes across decades, compounding quietly in the background, while the world debates faster-moving stories. And then one day, without warning, it stops being background noise and becomes the only story that matters. That is exactly where the silver supply crisis stands today. The number that serious analysts keep returning to is 2016. That was the year global silver production reached its peak. The world pulled more silver out of the ground in 2016 than it has in any year since, and according to current projections, it will not return to that level of output until approximately 2030. That means the planet is operating inside a 14-year window of structurally constrained silver supply, not a temporary dip, not a 1 or 2 year disruption. A 14-year ceiling on how much silver the world can produce regardless of how high the price goes or how urgently the market demands more. Mining does not respond to price signals the way financial models assume it does. When silver prices rise, the textbook expectation is that miners rush to increase production and new supply floods the market. But silver mining does not work that cleanly. Most silver in the world is not produced from pure silver mines. It comes as a byproduct of copper, zinc, and lead mining operations. That means silver output is often a secondary decision made inside a much larger operational context. Bringing new dedicated silver production online requires years of geological surveying, permitting, environmental review, infrastructure development, and capital commitment before a single additional ounce reaches the market. And while production has been constrained, consumption has done the opposite. The silver market has now recorded 6 consecutive years of global supply deficit, 6 years in a row where the world consumed more silver than it extracted from the earth. Every year that deficit continued, the physical stockpiles that underpin the paper futures market absorbed more pressure. Every year, the gap between what the world needs and what the ground can provide grew wider. 6 years of deficit does not resolve itself quietly. It resolves itself in the price. There is a shift happening inside the silver market that most casual observers have not yet registered. Not a trend, not a cycle, not the kind of movement that corrects itself when sentiment changes or when a new administration adjusts its energy policy. What is happening on the demand side of the silver equation right now is structural, permanent, and accelerating at a pace that the supply side of this market is completely unprepared to match. A few years ago, industrial demand represented approximately 47% of total global silver consumption. That number today sits at approximately 67%. That shift, 20 percentage points in a relatively short window of time, is one of the most significant demand transformations any commodity market has experienced in the modern era. It means silver is no longer primarily a monetary metal sitting in vaults or a jewelry metal sitting in display cases. It has become an industrial input that the most important and fastest growing sectors of the global economy cannot function without. 3 industries are driving this transformation simultaneously, and none of them are slowing down. The first is solar energy. The Solar Energy Industries Association has documented that photovoltaic manufacturers consumed over 25% of total annual global silver supply in recent years. Every solar panel requires silver, not as an optional component, not as something engineers are actively working to eliminate. As a fundamental part of the electrical architecture that makes the panel perform at the efficiency levels the market demands. Silver is the most electrically conductive element on the periodic table in advanced photovoltaic technology, requires exactly that level of conductivity to function at scale. The second is electric vehicles. Every electric vehicle produced today uses silver in its wiring, its sensors, and its battery management systems. As global EV production scales from millions of units annually toward tens of millions, the silver embedded in each vehicle multiplies into a demand figure that did not exist at this magnitude just 5 years ago. The third is artificial intelligence infrastructure. Every data center being constructed to power the AI revolution requires silver in its components and connectivity systems. And data center construction globally is not slowing. It is compounding 3 revolutions running simultaneously, all of them hungry for the same metal, all of them drawing from a supply base that peaked in 2016 and has not recovered since. The mathematics of this situation are not complicated, they are just not yet priced in. There's a meaningful difference between what markets say publicly and what serious institutional money does quietly. Retail investors follow headlines. They respond to price movements after they have already happened. They buy when confidence is high and sell when fear takes over. Institutional capital operates on a different timeline entirely. It moves before the crowd understands why. It positions itself inside the structure of a market long before that structure becomes visible to the average observer. And when institutional research desks begin revising their forecasts upward by significant margins, that is not noise. That is a signal worth understanding carefully. JP Morgan is not a firm that makes careless predictions. It is one of the largest and most influential financial institutions on the planet. Its research reaches the desks of pension fund managers, sovereign wealth funds, family offices, and institutional allocators who collectively control trillions of dollars in capital. When JP Morgan revises a commodity price forecast, especially by the magnitude they recently applied to silver, the capital that follows their research does not sit still. Their revised forecast projects silver to average approximately $81 per ounce across the full year of 2026. That number is more than double the average price at which silver traded through 2025. The 3 pillars supporting that forecast are tight physical supply, strong and growing industrial demand, and a macroeconomic environment defined by falling real interest rates. Each of those pillars has been examined in the earlier parts of this analysis. Together, they form the foundation that JP Morgan's research desk decided was strong enough to justify a forecast revision of historic proportions. But JP Morgan issued a warning in the same breath, and that warning deserves equal attention. Their analysts noted clearly that silver remains vulnerable to corrective pressure, particularly if a meaningful portion of the recent price movement was driven by speculative positioning rather than genuine industrial demand. Implied volatility in the silver futures market has been running at extremely elevated levels. And when volatility runs this high, the moves happen in both directions with equal force. Investing Haven, which has tracked silver cycles for over 2 decades, echoed a similar caution in their February 2026 update. Their leading indicators are flashing bullish signals across the board, but they acknowledged openly that the scale of the January rally exceeded even their most optimistic projections. A retest of lower levels, potentially toward $50, remains a possibility before the longer-term trend fully reasserts itself. Institutional money is not predicting a straight line higher. It is preparing for a journey that most retail investors will not have the patience to complete. There's a movement happening inside global financial markets right now that is large enough to reshape asset valuations across entire categories of investment, and yet it is being discussed in only the quietest corners of serious financial analysis. It does not have a catchy name. It has not been given a hashtag. It will not be explained on mainstream financial television in simple terms because the implications of naming it clearly are uncomfortable for the institutions and governments whose credibility depends on the existing system appearing stable. But the data is not subtle. Gold and silver are up 21 and 25%, respectively so far this year as of the latest available figures. The S&P 500 is flat over the same period. Bitcoin has experienced significant drawdowns as leveraged positions were unwound across crypto exchanges globally. Those 3 data points, sitting side by side, tell a story that serious analysts are not ignoring even if mainstream commentary has not yet assembled them into a coherent narrative capital is rotating. It is moving away from assets whose value depends on a balance sheet, a quarterly earnings report, a server, or the continued confidence of a counterparty. And it is moving toward assets that have stored value across centuries without requiring anyone else to perform, deliver, or remain solvent. Gold and silver do not have earnings calls. They do not have chief executive officers who can make a decision that destroys value overnight. They do not carry counterparty risk. In an environment defined by policy uncertainty, artificial intelligence-driven labor disruption, and geopolitical tension running simultaneously across multiple theaters, that quality is being priced in with increasing urgency. Then there is China. Chinese gold exchange traded fund holdings rose 52% between late August 2025 and the end of January 2026. The World Gold Council described that pace of accumulation as historic. This is not retail enthusiasm chasing a trend. This is the second largest economy on the planet, making a sustained, coordinated, and deliberate decision to move institutional capital into hard assets at a scale and speed that has no recent precedent. When China moves in a direction with that consistency and that magnitude of capital commitment, the rest of the global market does not lead. It follows. The rotation has already begun. Most investors will only recognize it clearly when it is no longer early enough to matter. Every major commodity market carries a risk that the models do not fully account for. Not the risk that appears in volatility calculations or shows up in implied options pricing. Not the kind of risk that institutional research desks build into their base case scenarios with clean percentage probabilities attached to each outcome. The kind of risk that lives outside the spreadsheet entirely. The kind that emerges from the ground level reality of how a physical commodity actually moves from the earth to the market, and what happens when that movement is interrupted by forces that no financial model was designed to anticipate. For silver, and for the United States in particular, that risk has a geography. It is called Mexico. Mexico supplies between 45 and 50% of all silver imported into the United States. That single statistic reframes the entire silver supply conversation for anyone serious about understanding where American industrial and investment demand actually comes from at the physical level. Nearly half of every ounce of silver that enters the United States supply chain originates from Mexican soil and travels through Mexican infrastructure before it reaches the refiners, fabricators, and exchange warehouses that the broader market depends on. And the situation on the ground in Mexico right now is not stable. Criminal organizations have disrupted transit corridors in key silver-producing regions with a frequency and intensity that has forced mine operators to halt production in certain areas entirely. These are not isolated incidents being managed quietly at the operational level. The disruption has escalated to a point where the United States government has entered the conversation publicly, discussing the possibility of direct involvement to secure supply chains that American industry cannot afford to lose. This is not a political story. It is a supply chain story of a magnitude that the silver market has not yet fully absorbed into its pricing models. When nearly half of a nation's supply of a critical industrial metal is sourced from a single country experiencing this level of internal instability, the word vulnerability does not adequately capture the exposure markets price what they can measure. They struggle deeply with what they cannot see coming until it has already arrived. The Mexico factor is visible right now to anyone willing to look at it seriously. It is not yet reflected in the price. And that gap between a known risk and an unpriced reality is where the most consequential market movements are always born. Everything examined across the 7 parts of this analysis leads to a single conclusion that serious decision makers cannot afford to misread. This is not a trading opportunity. Trading implies a short entry and a clean exit. It implies a defined window of time, a price target, a stop loss, and the kind of emotional detachment that comes from knowing the position has a beginning and an end that can be planned in advance. Trading is what the crowd does when a market generates excitement. And silver right now is not generating excitement. It is generating something far more valuable to those who understand the difference. It is generating structure. The technical picture on February 25th, 2026 shows silver attempting to break and hold above the $88 to $89 resistance zone. If it succeeds, analysts are watching $90 and $92 as the next meaningful levels where the market will test whether buying conviction is deep enough to sustain the move. If it fails and breaks below $83, the downside scenario reopens and lower levels come back into serious consideration. That is the short-term map. It matters. But it is not the full story, and treating it as the full story is the mistake most market participants are currently making. The full story lives in the fundamentals that do not change between sessions. 6 consecutive years of global supply deficit. Industrial demand that has shifted permanently from 47 to 67% of total consumption. A 14-year ceiling on production that mining cannot resolve quickly. Institutional forecasts revised upward by magnitudes that reflect genuine structural conviction. Capital rotating out of counterparty-dependent assets and into metals that have stored value across centuries. A Mexico supply chain risk that is real visible and unpriced. And a Chinese economy making coordinated hard asset accumulation decisions at a historic pace. None of those forces resolve themselves in a single session or a single month. They build, they compound, they exert pressure on price over quarters and years in a way that short-term volatility cannot permanently suppress. The serious investor understands this. The serious business mind understands this. Patience in the presence of genuine structural conviction is not passive. It is perhaps the most active and disciplined decision a decision maker can make in a market environment this complex. Watch the COMEX physical inventory numbers. Watch open interest as delivery months approach. Watch the dollar. Watch China. Because silver is not waiting for the market to understand what is happening underneath it. It is simply, quietly, and with absolute certainty, rebuilding.